All right.
Okay.
So yeah, you said that you were going to explain to me
Yes.
a novel concept. The concept being there's apparently only two places that your money can go if you decide to save it, correct?
Correct. There's always sets of twos, right? When you have money, you can either keep it, and we'll talk about that, or decide to spend it. So if we talk about the keep side, there's essentially only two places where we can put money, and that would be in either the banks or the insurance companies. If we put the money in the banks, then of course, then you have two choices again. In the banks, you have commercial banks,
Okay.
or you have the investment banks.
Okay. Commercial or investment. Okay. If we do the bank route, commercial or investment.
Right. So in the commercial banks, you have checking account, savings account, money market account, as distinguished from the investment world as money market funds. You have checking, savings, CD. We talked about that before in one of our earlier videos.
Certificate of deposit.
Right, and any other number of accounts. And then, of course, the banks have things like credit cards. They bundle money and have home loans and things. So that's where all of the money in the economy goes, is through the bank at one point or another.
Okay.
Right? So the other option, if you, and by the way, at the bank, you have FDIC, an insurance component, Federal Depositors Insurance Corporation. You have protection, right? And so if you don't choose that route, you then can take money and put it at risk, and you can use an investment bank. And the investment banks then cannot guarantee your money. That's the whole purpose of it. The opportunity to make more money gives with it the chance that you can lose all of the money. Right? So then you have the simple accounts that are super low in risk, that are as I just said, money market funds, and progressing on up through different things like bond funds. You have stocks, you have bonds, you have any number of arrangements in the investment world where your money again has the opportunity to make a lot more money. It's leverage, but it also, there's the chance that exists that you could wake up and there's none. The probability that you'll wake up on any given day and there's none may be slim, but it exists, particularly when you buy things that are more aggressive stocks like penny stocks and things like that. Okay, so that's on the banking side. The insurance companies, on the other hand, are what I call the keepers of life, right? They make sure to cover for any type of loss or unforeseen events. So on the one side of the insurance paradigm, you have the property and casualty side, where they will take care of and restore things like your property, your house, your car, your boat,
Correct.
your motorcycle,
Correct.
your thingy, whatever that is, right? And then on the flip side of that, you have life, health, and disability. So on the life side, they're making sure, because you can't replace a spouse.
Yes.
Right? Well, you can replace a spouse with another spouse. But you can't really replace a spouse. You can't replace a person,
Yes.
right? When they're gone or when they're hurt, that thing is gone or hurt. If you lose an arm, you can get something like an arm, but you can't get that arm back.
Correct.
Right? So in the event you don't live long enough, the life insurance companies come in to protect the family for that.
Okay.
But in the event you live too long, then the insurance companies, the same, are able to take care of things like that. So in that, because they have that responsibility, those are the keeper of all your retirement arrangements. And unbeknownst to most people, when they look at their 401ks and they look at their different statements, although it might have the name of an investment bank on it, if they look down at the fine print in there, they'll see that it's an insurance company that's involved. So with retirement arrangements, you might see some that are from insurance companies, but those that don't look like they're from insurance companies are from insurance company subsidiaries or attachments.
Okay.
Yeah.
Okay. So, as you've just learned here, apparently there are really only two places where your money can be saved, right? It's either the bank by way of the commercial bank or the investment bank, or it's an insurance company.
That would do property and casualty, or it would do the life, health, and disability. So yeah, money doesn't go in many places, although the consumers believe there's all these different options.
Yeah.
And with all of the confusion, money is made. But if a person would say, for example, why invest? I buy houses. Well, I always say, name me one housing transaction that does not go through a bank. Name one. There are none. So the money's going through one of these different sort of flows. It has to be one or the other, no others.
You heard it here, okay? So stay tuned because we're going to have more segments like this where we break things down so that it's very easy for you to understand what your money's doing and how you can potentially make more of it, save it, protect it, whatever you want to do with it. Come back and we'll share that information with you. Take care. Wave, Dad. Take care.
Bye now.